Really?
So good morning. I think we can start. One
Ah,
student joined. Yeah. Others will, I think, join once we start, but we'll continue.
okay, thank you. Okay, good morning. Uh, Last week we discussed about the employment income. As I explained in the income test, there are four sources of income. That is employment income, business income, investment income, and other source of income. Uh, we discussed here last week employment income. Actually, employee doesn't want to calculate. The inland department has calculated income tax on employment on all the scenarios and directed the employer to deduct and pay tax to the inland department. As we discussed, employment income, you can't deduct any expenses other than the qualifying payment of 1.8 million. So IRD has schedules all the pay it as table by deducting that 1.8 million. So today we are going to discuss other source of income, that is business income. Okay. So I told that in the income tax we have to careful about two words. One is means. If the word use means, that means you specify something. The other one is includes. When you say includes, you are not giving a full definition for that word. They say something includes. The similar type of things can be included. Likewise, business. That has not defined in any act. I think in any act in the world, the business has a wider meaning. So always business says business includes. Okay. So business includes a trade, profession, vocation, or isolated transaction with a business character. However, short the duration of the arrangement and a past, present, or prospective business. So this business income exclude an employment. I told you, uh, as per the income tax law, there's a dominant principle. That then if the particular income, then order is employment income, business income, investment income, and other income. If the particular income can go to employment income and business income, it should be treated as a employment income. So we discussed, if, for example, a particular employee maybe sign a service agreement, but then if you look at the nature of the activities, I explained, it can be a employment income, although it is a service contract. So that happen as per the dominant principle. So in the business section, that's why an employment has been excluded. If that particular income should be treated as an employment income, then you can't treat it as a business income. Okay. So we go to the next slide. Next slide. When we are studying the business income, we have to understand there are actually four kind of assets. One is investment assets, other one is capital asset, other one is trading assets. Trading is stock. Also, we treat it as an asset. Yeah, last category is depreciable asset. So you can see all these assets have been defined. You can see means, investment asset means, capital asset means, okay, trading asset means. So specify what those assets are. First, we look at what do you mean asset. The word asset also, they say includes. Asset, the word asset has not been defined, but asset, they say includes. Asset includes a tangible or intangible asset, currency, goodwill, know-how, property, a right to income or future income, a benefit that lasts longer than 12 months and a part of the asset. So that's why they have defined asset. Then we will go to the other category of asset. So the other category, one asset is investment asset. Actually, investment asset come under the investment source, but we will look at the moment. The investment asset means a capital asset held as part of an investment, but exclude a principal place of residence per individual. Again, principal place of residence if you, is not treated as investment asset. As why that if you own a particular resident house for more than 3 years, and if you have lived there more than 2 years time, that capital gain is exempt. That's why they basically excluded your principal place of residence, provided it has been owned by the individual continuously for the 3 years. That's why I say 3 years before disposal and lived in for at least 2 of those 3 years, calculated on a daily basis. By the time of that property, you have been lived there more than 2 years. The ownership should be more than 3 years. So that's the investment. The investment is a capital asset held at capital asset. It is a capital asset. Investment asset is a capital asset, but held as a part of investment. Okay. Then we go to capital asset. The capital asset means each of the following asset. Then when you look at the word means, only these are capital asset. None of asset other than this does not come to this category of capital asset. If you look at capital asset means each of the following asset, the land of building are treated as a capital asset. Membership interest in a company, partnership or trust. That means if you have shares in a company or partnership or trust, that should be treated as a capital asset. A security or other financial asset. For example, if you have a fixed deposit or something like that, it should be treated as a capital asset. An option right to other asset in asset referred in the foregoing paragraph, but exclude trading stock or depreciable asset. So, in the meaning of capital asset, they have particularly excluded trading stock and depreciable asset. Then we have to look at what are these trading stocks and depreciable asset. Trading stock means asset owned by a person that are sold or intend to be sold in the ordinary course of business of the person. Work in progress, and work in progress also come under the trading stock on such asset. Inventories of material to be incorporated into such asset and consumable stores. For example, if a land selling company, that building, but building is, it is a, so the capital asset category is land, and building is a capital asset, but it is to be sold. Okay? It is to be sold, then it should be treated as a trading stock. It is not because it is comes in your P&L and the inventory. That is that building is not treated as fixed asset in the balance sheet. So because those building you are constructing to the purpose of sale, not to use for the business. That other category is depreciable asset. Means an asset to the extent to which it employed in the production of income from a business and which is likely to lose value because of wear and tear, obsolescence or passing of time, but exclude goodwill and interest of land, membership interest in entity and trading stock. So we will going forward. We can see there are 5 categories of, now basically there are 6 categories of depreciable asset. When you look at those depreciable asset, you will understand better what are the depreciable asset. So I think it is very clear to you. Asset in the act have identified 4 kind of asset. One is investment asset, one is capital asset, one is trading stock, other one is depreciable asset. Today we are talking about business income. For business income, this investment assets is not applicable. Investment, so the selling of investment assets come under the category of investment income. Other than that asset, all other 3 assets come under the category of business income. We go to next slide. So you can see like, but then we should know what are these business income. In calculating person gain and profit from conducting a business for a year of assessment, the following amount derived by person during the year of assessment from the business shall be included. Again, that is shall be included. That means similar type of categories can come under the category of business. Okay. The service fees, as I told you, our professional services income, that is treated as a business income. That's why this when we are doing independently something, you are giving some service, then you have to calculate tax on that income and pay to the inland Revenue department, not like the employment income. Employment income, as you know, inland Revenue department has guided the employer to deduct tax. Then employer deduct it on behalf of you. Employee doesn't has to do anything. But service fee is given, that it come to you, then you have to calculate it and you have to calculate tax on that service fee and pay tax to the inland Revenue department. Consideration received in respect of trading stock. So then trading is, I told you that three categories of asset, trading stock. When you sell the trading stock, that is also your business income. It is obviously, if you are, if you have a stock, when you sell that stock, you are getting money. That money, that income should be treated as part of your business income. Then that is consideration received in respect of trading, but you are buying and selling your stocks. But the other word gain from the relation of capital. As I told you, this capital asset also come under the category of business income. The word used is gain. Why we use then, you know, income tax? If you look at the topic, it's the calculated person gain and profit from conducting business. A person gain and profit from some activities, you will get profit. Some activities you will get gain. For example, asset. When you dispose asset, that is not a profit, that is treated as a gain. Okay. So gain from the realization of capital asset. If you sell a capital asset, then you are getting gain. The other category, realization of person depreciable asset. If you buy a depreciable, I will let you know going forward what are the depreciable asset. When you realize that depreciable asset, if you sell that depreciable asset, that income should be treated as your business income. Then consideration for accepting a restriction on capacity to conduct a business. That is also treated as a business income. Consideration for accepting or restriction. For example, you are getting something to accept in your capacity to do something. Other than there can be restriction. You agree with somebody not to do something to benefit of other person. Then you are getting some income. That's why they say consideration you received for accepting or restriction on capacity to conduct a business. You are not doing particular business for the benefit of others. For that other person is paying you. Okay. So that income also should be treated as a business income. Then look at the other category. Gift received by the person in respect of the business. Gift. Even we saw that even this word gift was there in the category of the employment income, or in the capacity of employment. If you are getting some gift, it should be treated as income. If it is in the course of employment, it is the employment income. If it is in the course of business, it is a business income. The amount derived that are effectively connected with the business. For this category, what happens is if you have investment income, if it is effectively connected with your business, for example, interest income. Interest income is, as per investment income, it is a part and parcel of the investment income. But it is connected with your business. For example, bank. For a bank, interest income is a business income. Why? Their main activity is borrowing and lending. Then what is the involvement is in interest income. Then you are paying interest, you are getting interest. Okay. You are the bank are investing in different areas. They are earning income. So that income should be treated as business income. As a person, when we are getting interest income from bank, that income for us is let's say investment income. for a person who are involved in the supply of financial services, for that category, this interest income should be treated as a business income. That's why amount derived that are effectively connected with because interest income, rent income, all are under investment income. If those are done as a business, it should be treated as business income. Other amount required to be included under this act. That's why they say that this start including so similar type of income should be treated as a business income because the word business has not been defined. So business shall be included. This the act is started like that. Then what should then when you are calculating the business income, this amount should be excluded. One category is exempt amounts and final withholding payment. So those are not those should not be treated as your business income. For example, if you have invested in foreign currency, that interest income is exempt from income tax. So that interest income should not be treated as a business income. Other categories, for example, you are getting dividend. When you are giving the pay of the dividend, they have withheld the tax, 40% tax deducted. That tax is a final withholding payment. Once you are getting dividend, you don't want to pay more tax. That is the final tax. Is paid by the payer. The investment company, when they are distributing dividend, they are paying tax to the IRD and remit the balance to you. That income, that dividend income is exempt from income. That's a final withholding payment. The tax paid by the payer is a final withholding payment. Amount that are included the calculated person income from employment. I told you, if the particular income can be categorized as an employment income, that should be treated as employment income, not as a business income. So that's why, as per dominant principle, number one is employment, number two is business, number three is investment. Likewise, they have categorized. Then I have taken I think few categories for you understand. Then you are required to specify the relevant income item for recognizing the following business receipt in the computation of business income as per section 62. Section 6 is the business source in the Land Act. So sale of manufactured biscuit. So that is why what is that? That is a business income. Repair income of a garage. That is what that is also is a business income. Insurance claim received for the loss of inventory. So that is also business income. Bad debt receipts. For bad debt, bad debts are allowed for only for business income. Then if you get the bad debt receipt, that is also is a business income. This rent income. Rent income is normally a investment income. Under investment income, it is categorized rent income as a investment income. But that rent income you are doing as a business. For example, you have a property, you have given that property as a business. You have a manager, you have a staff, you are maintaining that property. Then you are conducting it as a not an investment tax. For example, if you have a one house that is given for rent, you are getting rent income monthly. That is an investment income. For that income, you are just given. That is basically passive type of income. You are not doing anything. You are just given your space to somebody. So again, you are getting. But if you are doing that activity as, as a business, so you are doing maintenance, you have staff, you are look after this thing, you have management to look after this operation. Then that rent income for that company, even per person, if you have a 5 properties, if you have rented house, you have a particular person to look after this thing. If you are maintaining, then even a individual person, that rent income can be a business income. For a company, normally, if a company getting a rent income, we normally treat it as a business income because no company does a business. Then interest income. Again, interest income, normally, interest income is an investment income, but if it is done as a business, especially for a bank, financial institution, it is a uh, business income. Profit from sale of machinery used in the factory. So that is very clear. That is also business income. Profit on sale of land. So profit on sale of land, this can be, this should be look at the nature of this land. If that land is used for the business purposes, then what is happen? That profit is a business income. Otherwise, for a person, if it is an investment as a for example, you have some land, you hold for a loan period, then you see that is the basically isolated transaction, one transaction. So that profit is an investment income. It's not a business income. If the particular land is used for the business purposes, then only that income should be treated as a business income. Cost of pre-pouring tour granted by the manufacturing company to other proprietor based on the sales performance. Then again, this is very clear. This is like a gift, like this is also business income. Sale of used bag in the shop. That is also business income. There is no doubt whether this is a business or investment. Those categories are very clear. Those are business income. Compensation received from the government considering the loss of branch business, then business in the highway construction area. That is loss of branch business. Branch business, then you are losing branch business means that consideration should be treated as your business income. The sale of liquor license used for the wine store. Sale of liquor license used for the wine store. So this line, then again, this is wine store that you have conducted some business. When you are selling that license, that also should be treated as a business income. So I told you from the employment income, you can't deduct any expenses, but the business income, you can deduct expenses. So then we will look at what are these deduction rules. Deduction rules, deduction will be discussed and relevant to business income and investment income. As I told you, the deduction cannot be deducted, any expenses cannot be deducted from your employment income. Then all the expenses can be deducted, neither business income or investment income. Similarly, if you have some sort of other income also, if the particular income is related to that other income, you can deduct that income. Basically, it is very unlikely because if you look at the broadly, all incomes come under employment, business, or investment income. If anything, if one can argue that anything does not come under that those three categories, only that type of income should be treated as other income. Otherwise, you have to basically look at whether those income comes under main three categories, that is employment, business, and investment. Okay. That's why deduction will be discussed relevant to business income and investment income. The general deduction of act in three main categories. That there's the general deduction rule, section 10 of the Inland Act. I have shared with your considered act. You can look at the section 10. There, the section 10 says general deduction. That what can be deducted, what can't be deducted. Generally, uh, so then general deduction, then we have a main deduction section 11. Then specific deduction, there are in addition to those two categories, there are specific deductions on section 12 to section 19. Okay, we will look at those areas now. General deduction section 10. General number one is no deduction shall be made in calculating person income from employment. We discussed last week also. The section starts from that. No deduction shall be made in calculating person income from employment. Section 10(1)(a). Some deductions are not allowable in calculating person income. Then it says some deductions are not allowable. We will look at what are those type of expenses. The first one category is domestic expenses. Domestic expenses mean basically your personal expenses. Your personal expenses cannot be deducted either from business income or investment income. So section 197 basically specifically define what are the domestic expenses. I have referred this section. You can go to that and read and understand this one. Expenses incurred by self-employed person on his or her own behalf of and expenses incurred by a person on behalf of an individual who is not a person incurring the expense respectively, while Section 103 denies a deduction for interest incurred with respect of money borrowed that is used to acquire the kind of benefit listed in the Section 100. That interest incurred for a particular for your some personal thing. If you have taken a loan and you have incurred interest income for that personal matter, for example, you have purchased something, say, AC for your home for the personal use. You have borrowed and purchased, then that interest income you can claim from your business because that AC machine you have used for your personal use. Okay. The tax payable under this act, whatever tax paid, you can deduct that as a cost. So interest and penalties, fine payable to government or political subdivision of a government of any country of breach of any written law. If you have paid penalties or fine to the police or some any court or somewhere, you can't, that expense is not allowed to deduct because that type of expenses are not treated as expenses incurred in the production of income, production of business or investment. General deduction, there are some more. The other category expenses of other deduction to the extent incurred by a person deriving XM amount of final withholding payment. That means if a particular expense is related to XM income, that expenses you can't deduct because that source is XM. If the particular expenses related to that XM income, you can't deduct that expenses. Similar to final withholding payment. For example, final withholding payment. Then if you are getting someone getting final withholding payment, that is you are getting income after deducting tax. So that is your final. You don't want to pay more tax. You can't deduct any expenses also from that final withholding payment. So dividends of a company. Okay. There's a definition is given under section 95. Outlay expenses for entertainment. So entertainment also there is a definition. We will go through going forward. We will discuss this one later. The entertainment expenses, particular entertainment expenses, initially even foods expenses for a and not treated now. Your principal, your business partner, if you are liquor or tobacco type of expenses only, otherwise normal, if you are given food expenses incurred for your business partner, someone, now it is allowed. All other entertainment expenses are not, cannot be deducted from your business income. The amount that person has transferred in his financial account to a reserve or provision for expenditure for losses, not yet incurred, but expected to be incurred in a future year of assessment. That means any provision, you can have different type of provision in your P&L. That type of provisions you can't claim. Amount incurred on lotteries, betting or gambling, other than amount incurred from conducting business or lottery. That means amount incurred for lotteries, betting or gambling, that type of expenses you can't do. But if your business is business of lotteries and betting and gambling, then you can deduct the related expenses. Those who are in that business category. For other person, you can't deduct it. Taxes or other levies specified by the Commissioner General and any tax levy which is not allowed to be deducted in calculated person income in terms of any other written law. There's a gazette actually, the gazette particularly listed down what type of taxes you cannot deduct from your business income. So we discussed these three categories. Repeat or something, domestic expense, tax payable, and this thing. Then a deduction for a payment shall not be allowed until the tax withheld has been paid to the Commissioner General. For example, there are we will discuss there are some expenses are subject to withholding tax. The withholding tax, if the withholder is not have not paid that tax to the government, then that deduction is not allowed. So withholder should pay that tax to the government, then the particular person can deduct that uh, cost as a uh, expense. For example, if you have rent, then if you are deducted 10% on renting a rented liable, then the other person he can deduct it as a rent expense. Rent expenses you have paid then, and you have remitted the tax on that to the government. Then only you can deduct. Otherwise, if you are not deducted tax, you can't deduct that expenses. No deduction shall be allowed except as expressly permitted by this act. Okay. Where more than one deduction applies, the most specified deduction shall be applied even if that result in the denied of the deduction. That means, so if you look at there are one income, one expense category can come under several categories. Then more specified one you have to select. That means one expense can be deducted at one time. For example, if the particular expenses come in 2, 3 times, you can't deduct it. You can deduct on the more specified area. You have to select. You have to define what is that expenses should be treated. Then only you can deduct. Even though that deduction can come under several categories. Then again, recently actually they introduced new this thing that if the payment should be that the government want to make the payment by way of checks, to the banking system. So they said if your cash payment is more than 500,000, you can't make that payment. If you make that payment more than 500 rupees, that expense is deducted. But there are exemptions. Normally, the government is always encouraging the people to business within this banking system. That is the idea. So, payment method allowed to account pay check, account pay bank draft, credit card, debit card, or electronic payment via bank. That means through the banking system, government want to do this type of payment. No deduction allowed for such payment when calculating income. Payment are not considered as the cost. If the particular you have made 500,000 other than in other way by cash, that expenses you can't deduct. For example, if you purchase some material, you pay 600 rupees by cash. What happens is that 600 rupees you can't deduct as your expenses. There are two exceptions. One is payment by government of Sri Lanka, payment by government of Sri Lanka, government isn't. Payment by government of Sri Lanka, government isn't. That this restriction does not apply. Government can do anyway, okay, by cash or by check or whatever payment. Payment by bank or finance instrument. For example, bank, if you go to the bank and if you ask 1 million in cash, bank can't say, no, I can give it by check here. You can withdraw any amount in cash from the bank. Otherwise, you can't do business. Yeah. So this restriction, this 500,000 restriction, payment restriction does not apply to banks or finances. Other person of payment prescribed the minister. The minister has specified some those areas also. This restriction does not apply. They recently introduced this one because actually government want to do transaction through the banking system. That's why government introduced this particular method of payment. The same thing, I think. Then main deduction that we discussed about all those are section 10. Now we come to the main deduction, that is section 11. So section 11 says in calculated person income from business or investment. That's why you said two words, business or investment. For a year of assessment, expenses to the extent that they are incurred during the year by the person and in the production of income. from the business or investment shall be deducted. Okay, very clearly. Expenses incurred in the production of income. What are the expenses related to your income, your profit? Okay, that expenses are allowed. So then you have generated some say some revenue you have for you. Yeah, there are particular expenses to generate that revenue. So all the expenses, as per this section, all the expenses are allowed. Then what, as I told you, on the income tax, what is tax is profit. So from your income, you deduct expenses, then you come to profit. So all the expenses related to earn that income is allowed. Then there's a restriction. Now, what is that? No deduction shall be allowed for a capital, an expense of a capital nature. So capital nature expenses you can't deduct. But there's a capital nature expenses. There's other areas you can deduct. That is claiming capital allowances. There's a specific section to claim capital allowances. For, that is called from your depreciable asset. Depreciable asset. That is also capital asset. You are allowed to claim as a capital allowances. So expenses of capital nature include an expense that secure the benefit capable of lasting longer than 12 months. That is how you should understand particular expense, whether it is a capital expenditure or revenue expenditure. Revenue type of expenditure you can claim. Capital expenditure you cannot claim. Then next say to capital expenditure. What do you mean by capital expenditure? Capital expenditure means expenditure that lasts benefit capable of lasting longer than 12 months. By incurring that cost, by that cost you are getting benefit for more than 12 months, but not only particular year of assessment. You are calculating your profit. That result into earn income for some few more years also. That means that from that expense you are getting longer period benefits. That's why that's the expenses called capital nature expenses. Then I told you that in addition to those two, there are third category specific deduction. There is specific deduction we can see section 12 to section 19. Section 12 is interest expenses. Section 13 is allowable for trading stock. Section 14 talks about repairs and improvement. Okay. Section 15 talks about R&D, research and development expenses, and agriculture startup expenses. Then marketing and communication under section 15A newly introduced to specific areas who are doing marketing expenses. So the capital allowance and balance sheet allowance under section 18, I said therefore depreciable asset you can claim capital allowance under this section. Losses on realization of business asset and liability. Section 7. If this year you have a loss, next year you can claim under this section. Deductible amount of financial cost. They say there is a restriction to claim financial cost that depends on your share capital and reserve and whatever amount you have, but there is a limit you can borrow. If you have taken more than that amount, then you can't claim that interest cost. That's why it says the borrowing has been limited to particular limit. We will discuss going forward. Then you will understand what is that restriction. That means total finance cost. Sometimes there can be a situation where you cannot claim total finance cost. A business or investment losses under section 19. Okay, we will why this type of specific deduction have been introduced. We should know that also. So that is because at the first section, we talk expenses incurred in the production you can claim, but capital nature expenses you can't claim. But this type of expenses can be capital nature. That's why specifically these expenses are allowed to deduct. If these sections are not there, you can't claim. There is no claim capital expenses as per the section 11. Section 11 says you can't claim capital expenses. That is why specifically these areas have been introduced in the Act. Then first we will go to the so if you look at this section, you will see the interest expenses you can deduct from your business income and investment income. For section 13 to section 17, okay. Now you can understand section 12 interest income, you can deduct it from business income or investment income. Section 13 to section 17, you can deduct only from business income. Then deduct amount of financial cost, you can deduct either business income or investment income, business or investment losses. Okay, we'll go with the interest expenses. That section 12 has mentioned what are the interest expenses for the purpose of the section 11. For the purpose of section 11, that's the main deduction. The interest incurred under debt obligation, section 191. They say what are the debt obligation shall be deemed to be incurred in the production of the income to the extent that the money borrowed under such debt obligation was used to acquire an asset that is used during the year in the production of income. That means if that particular asset, for example, if you have purchased an AC machine for your business, that machine you should have been used for that business. Then only you can deduct the money borrowed under such debt obligation or used to acquire an asset. You take a loan. That loan is used to purchase a particular asset. That asset is used during the year. If that particular asset was not used during that year, then you can't deduct that interest expenses. So that means that interest expenses should be related to your income. In any case, the duplication was incurred in the production of income. For your day-to-day activities, if you have if you have borrowed money to use that for day to maybe you have to pay tax or to pay your salary, so to buy some raw material, things like that. If it is incurred in the production of income, that interest cost you can deduct. Again, there's a subject to that financial cost restriction. We will discuss it later. We will go to see simple example to understand what type of interest expense you can deduct. Mrs. Sanjeevani runs a beauty salon with a spa. For year of asset in 2025-26, she borrowed the funds from Bank A. Same year of asset, she uses some of the funds to purchase a new sauna bath. She also uses some of the funds to pay the rent on the premises she runs her salon. Okay. The remainder funds are used to pay for her child admission fees for school. Ms. Sanjani pays interest on the loan. The Sanjani has borrowed a loan. Now she is paying interest. So that borrowing she has used for these categories. We will see what type of expenses can be deducted. Purchase a new sauna bath because the sauna bath and asset that Mrs. Sanjani uses in running her business. So, not allowed section 11. Why? It is a capital expenses, but deductible under section 12. Even though it is capital, you are paying interest for capital nature something, under this section you can claim. Rent on the premises she runs her salon. Fund are used in the production very clearly. For her premises he used for her business. So that rent, rent. Funds used are used in the production of income from business. Deductible under section 12, very not clear. Pay for her child admission fees for school. Then what happened? Funds are not used in the production of income from the business. Then this interest portion cannot be deducted. Then you have to proportionally you have to look at from interest income portion you can deduct, portion you cannot deduct. For example, particular say you 150,000 plus 200, second 150, then 1/3 of interest you can't claim. proportionally you have to arrive what can be claimed, what cannot be claimed. If particularly you are used for personal type of thing, that type of interest cost you can't claim. That's what it said. Then allowable allowance for trading stock. That is also trading stock means asset owned by person that are sold or intend to be sold in the ordinary course of business of the person. Work in progress of such asset, inventories, material to be incorporated into such asset and consumables. The definition of capital asset and depreciable asset exclude trading stores. For example, if the trading stores not capital asset and depreciable asset. The capital asset, if it is a capital asset, it comes with your balance sheet. No, you can claim capital allowances depending on the depreciable rules. Depreciable asset also is not a trading stock. So that is used for your business, your computers, your photocopy machine, your motor vehicle, things like that. That is a depreciable asset. You have not purchased those type of assets not to sell, to use for your business. So depreciable asset also does not come under the trading stock. Trading stock means the asset owned by a person that are sold or intend to be sold in the ordinary course of business. So very clearly, your trading stock, that trading stock you can do, but this although this is a type of capital nature, you should be able to deduct from to earn your uh, profit, because as we told, from profit is liable to income tax. To earn profit from your revenue, you have to deduct expenses. Then you come to the profit. That profit, there are some allowable and disallowable expenses under this act. After those adjustments, you have to calculate and pay tax. Then allowable trading stock is further explained in the act. For the purpose of calculating person income from business for year of assessment. Again, remember this trading stock is applicable only for your business income. When you are doing business, then you have a trading stock. For investment income, this trading stock does not apply. For the purpose of calculating person income from business for year of assessment, in respect trading stock of the business, allowable calculate under section 2 is available. Then again, it says basically how you should calculate the trading. Is basically, this is how your accounting standard you calculate your trading stock. This is similar to accounting standard. So that formula is given. Opening stock, purchases, you deduct closing is that way. You can come to the allowable trading stock. Current accounting standard follow this mechanism. So you don't want to do anything. So whatever in your balance sheet as a stock, you can deduct. Then again, this is also similar to your accounting standard. The closing, they how to calculate your closing stock when you deduct opening stock, purchases, and closing. You deduct closing stock. That again, this is actual as per your accounting standard. So that way you have to arrive your. This is how to calculate your. When you look at the section 13 of the Inland, you can further. They have given all these principles to come to your allowable trading stocks. Then we come to the next category. That's a capital allowances and balances allowance for section 8. That is for claiming capital allowance. This is again applicable only for business income. If you are doing business, then only you can deduct capital allowances. From your investment income, you can't deduct. Okay. So we will look at what are the capital, how to calculate capital allowances. A person is entitled to claim capital allowance of such person is owner of the depreciable asset. Main thing is that depreciable asset. We discussed what is depreciable asset. You should be the owner. Ownership should be there. For example, under old act, if we have built, if we have constructed the building under somebody else building, you are allowed to claim depreciable capital allowances. Under this act, you don't allow. The ownership should be there. You should own the land, then on that land you should construct a building, then you can claim depreciable asset. The most important thing is the owner of the depreciable asset, they can claim capital allowances. Uses them at the end of the year of assessment, the production of person income from business. So that particular asset should be used during the year for the production of income. For example, if you have purchased machine, that machine is qualified to use capital, but that particular machine is not used during the year. What happened? You can't claim capital allowances for that machine. That machine should have been used for your business to qualify to claim capital allowances. Capital allowances shall be calculated according to the straight line method. Under there's a straight line method you have to apply. For your accounting purpose, you can apply other way also, but for income tax purpose, should according to straight line method should be capital allowance will be granted for the year of acquisition. Full capital allowance will be granted for the year of assessment. And from the year of acquisition asset, if that particular asset is used for the business, you can start claiming capital allowances. Capital allowance will not be granted for the disposal. If you dispose the asset for that year, you can't claim. In the year of acquisition, you can claim. In the year of disposal asset, you can't claim. Okay. Shall not be deferred to later year of assessment. That means if you purchase this year, continuously you should claim that. For example, if you claim per se, second year you do not claim, third year you claim, like that you can't do that. If you start claiming continuously, you should continue claiming. Shall not be granted in respect of road vehicle other than a commercial vehicle. Not the road vehicle, commercial vehicle, only commercial vehicle. Bus or minibus, a goods vehicle or heavy general purpose of specific truck or trail or motorcycle. Well, motorcycle also you can claim capital allowance. So this kind of for example, your personal car, you can't claim capital allowances. Okay, we will see what are the mean. What do you mean by commercial vehicle? Any vehicle come under commercial vehicle, you can claim capital allowances. For other vehicles, you can't claim. This is the method of calculating capital allowances formula. A divided by B. A is the depreciable basis of the asset at the end of the year of assessment. Okay. B is number of years provided in the procedure. Procedure A, they has given. We will look at those procedure. So then you can arrive the amount payable for a year of assessment, particular year of assessment. Okay. If there are 5 years, you can claim capital service within 5 years, like as per this formula. Where depreciable asset owned by a person is only partly used in the production of income provision at the end of the year of assessment, the cost of and consideration received for that asset shall be apportioned according to the market value of that part of the asset that is used in the production of income from that business and that part not. Where depreciation asset owned by a person is not partly used in the production. For example, your depreciation asset is not you are not fully utilized for your business, maybe used for your personal use, something like that. Then you have to proportionally claim particular for example, you have building, part is used for your personal use, part is you say you have doing business, you have rented out or something like that, not rented out for business. For example, you have a hotel, part you lived, part you use for the business. Whatever you use for personal purposes, you can. That's what it says. That means this expense should be related to your income. If it is used for personal type, that part is not allowed. The depreciation basis of depreciation asset of a person at the end of the year assessment shall be a sum of the depreciation basis of the asset at the end of the previous year of assessment, amount added to the depreciation basis of the asset during the year of assessment in respect of addition of the cost. For example, after you purchase asset, there can be addition. So that addition also you can continue claiming capital allowances. Then we will look at the what do you mean by commercial vehicle. So only this type of vehicle you can claim capital allowances. Commercial vehicle means then again commercial. I told you you have to make sure two words. One is means, one is include. This commercial vehicle has been defined. Then only these are the commercial vehicle. Nothing beyond that can be a commercial vehicle. A road vehicle designed to carry loads of more than half a ton, carry more than 13 passengers. That means your car, you can't carry more than 13 passengers, no? Maximum we can go only 5 people, no? So that's why. Vehicle used in the transportation. Vehicle used in the rental business. Or even for a car, if you are doing a rental, if you have the car is you go even for rent, then this business you can see that now they are widely this business can be in Sri Lanka, we can see in Sri Lanka. So rental purposes, if you are using cars, then you can claim capital answer because you are doing from cars. This cars you are not used for your personal use, you are doing for business. Okay, rental purposes. You are renting out the vehicle, then you are earning income. So that income is liable. Then that particular vehicle you can claim capital losses. So you should remember only those rental purpose use cars only you can claim. For example, uh, workers tours like that, they are organizing tours. They have vehicle, they have own vehicle. So then they are transporting to a tourist to use that vehicle to transport tourists, and then you can claim capital allowance for that type of cars, even though it is a car. That car is used for the rental business. You are getting income from that cars, since that cars. These are the, I told you what are then you can see what are the depreciable period of claiming also. Other than building, you can choose the category 4, building, structure and similar work. All other you can claim within 5 years, that means 20%. For building, it is 5%. 5% means within 20 you can claim the cost of the building. All other assets, remember the period of claiming capital assets 5 years. There are basically there was basically 5 categories. Now recently they have introduced one more category that's under 6. First category is computers and data handling equipment together with peripheral devices. So together then when you are purchasing computers together with peripheral devices, maybe software and everything it is included. For the total cost, you can claim within 5 years. Buses, then second category, buses, minibuses, goods vehicle, construction and earth-moving equipment, heavy general purpose specialized trucks, trailers, and trailer-mounted containers, plant and machinery used in manufacturing. So 5 years within that type of vehicle, you can claim within 5 years. Then railroad cars, locomotives and equipment, vessels, barges, tugs, and similar water transportation equipment, aircraft, specialized public utility plant, equipment and machinery, office furniture, fixtures, and office furniture also come under this category, fixtures and equipment, and any depreciation not included in under classes. Similar type of asset you can claim within again 5 years. That means 20% of 5 years period. Then building instruction similar work of permanent nature. So building basically you can claim within 20 years. That means 5% per year. That building you should have a ownership. If you have ownership only, you can claim building. You should have own the land. You purchase the land. On that land you construct a building. So under old act, even if you have constructed the building somebody else land, you don't have ownership. But if you are constructed, then that rule was when the old act constructed then used. If you have constructed, if you have proved that you are the one who constructed that land, that building for the purpose of your business, capital you should be able to claim capital answers. But in this act, it clearly said own and use, not constructed and use, own and use. the ownership should be with you to claim capital allowances. But even though that type of you don't have ownership, but you say you construct a building, but that that big cost also you can claim under fifth category. Intangible asset, including excluding goodwill. You goodwill you can't claim that, but intangible asset. For example, you take a land on lease, then you don't have ownership. Ownership is the lessor. But you say you have taken that land for a period, lease out that land for say 10-year period. Then what time basically for a keys outlet that you can see that most of keys outlet they have leased out maybe 30 years, like some longer period. They have constructed building. For that building, for the lifetime, for example, if the leasing period is 30 years, you can claim the capital reserve within that 30-year period. That means even though you don't have ownership of the land, because land is leasehold land, the building is on the leasehold land is still under this category. You can claim capital allowances. It said that actual useful life of the intangible asset. Or if you don't know the actual useful life, then it is limited to 20 period. For example, if you purchase a particular software, well, if the particular software under first category, when you are purchasing computer, if it is there, that is computer, you can claim within 5 years, no problem. But after that, say you purchase some other software that is an intangible asset. You say, for example, that software you can say you can use for a period of 10 years. Then you can claim within 10 years. But you have purchased software, you don't know. You don't know how long you can use it. Then it is limited. Then you should be 20 years. Within 20 years, you can claim it. If you know the actual useful life within that period, if you don't know, it should be within 20 years. That means 5% of the cost you can claim for year of assessment. Then recently they have introduced one more category, milking machine with the latest technology used to manufacture local liquid milk related to products. So this category is particular industry. Within 2 years, you can, because they are considering their cost and everything, they have got shorter period to claim capital allowance. For that, all the cost you can claim within 2 years. That means 50% per year. Then what do you mean by accessible charge? In this section, the word accessible charge, where depreciation asset a person is realized. So you purchase depreciation, you claim capital in the within the mid of the year, you sell it. Okay, that is the whole accessible charge. How to calculate it? Where depreciation person also realized by the person before the end of the year of assessment, because for example, within the you claim, but as we told, year of disposal, you you can't claim capital losses. For example, before the end of the year, if you sell the asset, then you have to calculate an assessable charge and should be there. And assessable charge is calculated person income for that year with the following formulas A minus B. A is the consideration received by the person during the year of assessment for that asset. B is the written down value. So, for example, you have you have purchased say machine for 100,000. Within 4 years, you have claimed 20%. That means 100,000, 80,000. That 20,000 is remaining. But the fourth, fifth year, what you do is within the fifth year, you sell that asset for say 30 rupees. Now tax written down value is 20. Then 30 minus 20, that 10 is liable. Say on the other side is, say for example, you have written down value 20, but you are selling at say 10 rupees, then you have a loss. That loss also allowed to claim. Okay, that's why this is capital balancing allowances. Okay. The total of capital allowances granted and calculated under the post schedule to this act in respect of depreciation shall not be exceeded the cost of the such depreciation. You can go maximum to the, you can claim maximum the cost of the asset. Balancing allowances are made in respect of depreciable asset realized during the year of assessment in respect of which capital allowances have been granted in that year and earlier, and calculated in accordance with the provision of the procedure to this act. Okay. You look at how it comes. Balancing number. Look at this one. Where a depreciable asset of person is realized by the person before the end of the year, person balance and allowance is the granted the person for the year calculated in the according to with the following formula. B minus A. B is the A is the consideration received. B is the written down value. Right? A is the consideration received. A is the received by the person during the year of assessment of the asset, and B is the written value of the asset at the time of realization. Okay. So that means here in this scenario what happened is you are incurring a loss. But in the A minus B is you are incurring a profit. B minus A, you are incurring loss. Even losses you can deduct. If the profit, you have to pay tax on that profit. That's what it says. If there's a assessable charge, first category we talk about assessable charge. Here, assessable charge. If it's assessable charge means A minus B. That means you are getting more than your written on value. For that, you have to pay tax. So balancing allowance is you are incurring a loss. That means you are selling the machine lower than your written on value. So balancing allowance also that is also you can claim. This is the section 14. We come to the other category of expenses, the repairs and improvement. Repairs and improvement. You know, this also basically capital nature expenses. That's why this is specifically allowed. That's why section 11 restrict the capital nature expenses. The section 14 permits capital nature repairs and improvement. For example, if to repair something, the it can be the benefit can come in more than 12-month period. If some benefits come more than even after 12-month period, it is a capital nature. But as per section 11, it is not allowed because it says capital nature expense you can't deduct. But under this section, you can claim uh, repairs and improvement. The repairs means, repairs is the same category, similar way you are doing repairs. Improvement is you are adding something. For example, you remove roof and you build a new fashion roof like that. That's an improvement. So you remove asbestos and put the asbestos, similar asbestos, that's a basically repair. But if you develop in other way, that can be improvement. So that way you can do even repairs and even though those are capital nature expenses under this section, it is allowed to claim. We will look at how to this claim. The deduction of improvement report is something we are talking about now. Improvement report to subsection and granted for any year of assessment commencing from 1st April 2020. That recently amended this thing. With respect to depreciation of a person shall not be exceed in the case of improvement to class 4 depreciable asset. Again, class 4 is a land, 5%. The improvement, if it has improvement, it should be within 20 should be claimed. Okay, in non-value. In other cases, all others, 5 years. So that improvement also should be claimed within these parameters. You can't claim more or less. Okay, shall be allowed in order to which the expenses are incurred. Excess expense for which deduction shall not be allowed as a result of the limitation in the subsidy shall be added then that amount should be added to depreciation basis of the year of assessment and you can claim in the subsequent year of assessment. So that when we are doing exercises, we can understand this. This further explain repair uh, in the event of written value reported section 2 is 0 for depreciable. If it is 0, what happened? You are fully claim capital losses. Then what happened? 12 years of assessment for a class 4 depreciable assets. 1/12. For example, you have your building, you within then 20 years gone. Now there's an improvement. Then that expenses you can claim within 12 years. For example, your furniture and fitting. You are fully depreciable. Now there's some improvement for that. For that cost, you can claim within 3 years. You don't want to wait 5-year period within 3-year period, that improvement cost you can claim. In this thing, improvement means, and again, you very clear, improvement means. Okay, I told you, you have to be very careful. The word means and include. When you use means, you specify something. In this section, improvement means the expenditure incurred by person to make additional alternation to a depreciable asset, which enhances the value of asset, but excludes the expenditure incurred to maintain or repair a depreciable asset, which temporarily enhances the value of such assets. Okay. That way, you have to understand what is the repair cost, what is the improvement, what is the improvement. Then I told you that when you are claiming interest cost under section 12, there is other section goes in line with the section 2, that is section 18. Your financial cost, there is a restriction to claim. Yeah, that means you can't claim your total finance cost if there are requirement you have not been fulfilled. We will look at that. The amount of finance cost deducted in calculating the income of a company other than the financial organism or bank. This section does not apply. They can claim any amount of finance cost. This is applied all other company other than financial organization, which is incorporated in outside Sri Lanka and having an issued share capital as at the end of which year of assessment and from the conducting business or investment for any year of assessment commencing on or after April 21 shall not exceed the limit referred in paragraph B of subsequent. We will look at what is the limit. Section 193B, a person incurred finance cost when the person incurred interest or losses with respect to financial instrument. For the financial instrument, there can be interest or losses. Okay, that how to claim that financial cost. This is the formula. This is formula after. Before that, actually there are some categories. There are three. You can claim within the limit was given three. Now here, all the companies after 1st April 21, the C is C. So we look at what is C. A is the financial cost of the year. B is the value of finance instrument on which the financial cost incurred during the year. That means your loan capital. C is the 4 is the total of issued share capital and reserve. That 4 times of your you can go up to 4 times of your issued capital and reserve. There are also three under before this period per particular section. It was 3 times of your total issued and share capital. Now for all the companies, it is 4 times. 4 times of your total of issued share capital and reserve of the company as at the end of the year. Deductible amount of finance cost section, finance cost of which the deduction is denied as a result of subsequent may be carried forward and readers. For example, if you have borrowed, for example, your share capital reserve and you for say 100, you have borrowed 500,000 loan. Then you can claim maximum. If your share capital is 100, you can go up to maximum. Your loan capital should be 400,000. Say you have taken 500,000. So balance part of interest actually it is not disallowed. You can carry forward and claim within next 6-year period. For example, we will look at some example, then we will understand this. Even if you can't claim that if you have gone more than that given period, for example, limit is you can go to borrowing up to 4 times of share capital and reserve. But if you have taken more, the particular year you can't claim, but corresponding there's a 6-year period. You have to you have to do the same formula, and you can claim your balance. You can claim within that 6-year period. Okay, we will take example, then you will understand this clearly. These are on the finance cost again. As per section 25, there's actually they have changes, in Land Act introduced 2018-19. Every year, from the budget, there are changes. But income tax it is always something, it is always getting changed. Just something comes in, something goes out from that, then we have to be look at every year what are the changes. So for the reserves included negative retained earnings, calculated accumulated losses, so depleted reserve, but excluded reserve arising from the revaluation of any other. If you have a revaluation reserve, that you cannot take as a reserve, share capital plus reserve into 4 times. If there's a revaluation reserve, you can't take it. Where an entity has negative retained earnings, accumulated loss, so deficit in reserve, the total of the issued share capital and the reserves of the entity shall be calculated, making into account such negative retained earnings, accumulated losses, or dividend. If you look at the example, then you can understand what it is said. Okay, I'll take a simple example. S Limited is a company engaged in the business of manufacturing. Okay, share capital asset 31st March 2025, say 5 million. You have reserve 2 million. You have long-term loan asset 1st April 2024 25 30 million. You have interest expenses 24 25, say 4.2 million. Next year we have paid 4.5 million. You can see 24 25 25 26. Share capital have not been changed 5 million 5 million, but share reserve, yeah, 24 25 you have 2 million. 25 20 you have 3 million. Long-term loan asset end of the year, first year 30 million, next year at the end of the year balance. But interest paid first year 4.2 million. Next year he has paid 4.5 million. We will see how we can calculate. Then the interest pay for the year of asset, we should know, paid at the average rate of 12% in the year of 21, 25, 15%. So then the average rate is given. The average rate we can find out what type of borrowing we have taken the particular year of assessment. Look at this example. So finance cost profit. Then 4.2 million divided by 12 into 100 at 35. Then you have paid 4.2 million for a borrowing of 35 million. You have borrowed means you have borrowed 35 million. What is your share capital? You can go maximum. You look at our share capital is 5 million, reserve is 2 million, altogether 7 million. Then we can go maximum 7 million into 4, that is 28 million. What happened? You have borrowed more than that given limit. You can borrow maximum 28 million, but you have borrowed 35 million. You have gone beyond that limit. Then what happened? Then formula is A minus B. We saw that formula A minus B into C. Then 4.2 million into 35 million into 20 million. Then maximum interest cost you can claim 3,360,000, but you have incurred 4.2 million. So for this particular year, only 3.3 million 6,000 is allowed. Then what? Then that year you, even though you have incurred 4.2 million, you are claiming 3 million 360,000. Balance 840,000. You can carry it forward to the next year. Okay. That is not fully disallowed, but there's a limit to claim this particular year of assessment. Then you can carry it forward the balance for the next year. We will look at the next year situation. Next year finance cost is 4.5. There's an average interest rate is 15%. Then we can see how much of borrowing there has been during that year. That means 4.5 million divided by 15 to 30 million. Then your reserve is increased by 1 million, and now you have a total share capital part reserve 8 million. 8 million into 4, 30. You can go up to 32 million. But you have gone up to 30 million. That you have not come to the limit. Now you can calculate how much you can claim for that year. 4.5 million into 30 million into 32 million. You can claim maximum of 4.8 million. But during the year, you have incurred only 4.5 million. What happened? Then you have a carried forward balance from previous 840. From 840, you can claim 300 million for this year. So balance 440, you can carry forward to the next year. Within 6 years, you can claim. But this particular second year, you can claim. But this 840 first year carried forward. But the second year, out of that 840, you can claim only 300,000. Okay. Then balance 540 you carry forward next year, and within other you have other 4 more years. Within 4 more years, you can claim that cost. Sometimes, if you can't claim, that part can be disallowed. Okay, that is how the section 11 says you can claim interest. Then when you come to section 18, it gives a restriction to claim. So you can borrow particular limit. Okay. Otherwise, part of finance cost can be disallowed. Then you are borrowing. Actually, you have to careful. You have to look at these provisions. Then you can, when you are calculating your income profit from business, you can deduct the losses. Okay. In calculating income from person from business, following shall be deducted, and only loss of the person for the year from the any other business, and that loss from the person from the previous 6 years assessment from the business, so other business. That means you know your losses you can carry forward, not only finance costs, all other losses you can claim. If there's a loss, you can claim within next 6 years. That altogether you have a 6 year period to claim losses. Yeah. The person may choose an income calculation in which a loss or part of the loss is deducted. However, where loss can be deducted under section 1 shall be deducted. एक business investment losses section 19. Notwithstanding provision of subsection 102, where a person makes a loss, and if the loss were profit, it would be taxed at the reduced rate. The loss can be reduced. That we deduct only in the calculated income tax at the same rate to reduce it. That is, now actually mostly now reduce the hotel sector. Initially there's lower rate. Some agriculture now almost all the companies now 30%. No, so 30%, very few sections there are lower rate. So this is actually not applicable now because you have basically you don't have the reduced rate income now, because only few areas we will discuss those things. Otherwise, now what happened, your loss can be claimed within 6 year period. We will, when we are doing a calculation, you can understand this one. This is how. So you should be what happened is your business, we have to make sure if it's a business loss, you can deduct it from your business income or investment income. If it is a loss from investment income, it should be deducted only from the investment income. That is the principle. Business loss can be deducted business income and investment, but if it is a investment loss from investment, that loss should be deducted only from the investment income. You can't claim investment losses from your business income. That is the principle. When you are doing some exercise, you will understand this. That's why I said unlimited losses from business may be deducted in calculated income from investment. Unlimited loss from the investment shall be deducted only in calculated income from investment. That is the main rule you have to remember. Business loss can be deducted from any sources other than employment. If you know employment, you can't deduct anything. Even if your other income, if it's a business loss, you can deduct from other source. Then again, this in this section, loss also it has been defined. Loss of a person for realization from a business or investment shall be calculated as the excess of amount deducted in accordance with that other than the under section 5 in calculated person income from the business or investment. This, as I said, up to 22, there was uh, re reduced rate. Now, actually, almost all companies have some common rate, 30% rate. That's what. So, investment income, and we did business losses. Investment income, you can set up against even business losses. Business income, you can claim anyway business losses. Like that. Capital gain, from capital, if you have capital gain, we will discuss what is a capital gain. From capital gain, you can't deduct any losses. your capital gain, you have to pay tax on that gain. You can't get any investment or business losses. Now, you are very clear. Now, as we told, interest expenses you can deduct business or investment. So this other the other section 13 to section 17 we discussed, those are applicable only for your business income. So detailed amount of finance cost also as that can be deducted from business and investment. Business or investment losses, again, this is applicable. For example, you can see section 12, 18 and 19 applicable to both business and investment. Section 13 to section 17 applicable only for business income. When you are calculating the income from business, that's how these sections applies. Because, for example, if you look at trading stock always involved with your business, very clear, repairs and improvement when you are doing a business. R&D, research and development, all are related to business. That's why it is that expenses allowed to deduct only for business income, capital allowances. Then that means you are using as asset to do some sort of business. Okay. Then losses for realization of business asset and liabilities.
Yeah.
Yes. Right.
No, other side. Yes. Then why we maintain two?
Then there's a transitional gazette. There's a number I just for your information.
What we
When we
gonna do? Copy.
hello, somewhere mute. Okay, just go to this thing when we are introducing this new Inland Act, but there's a transition provision. One is there under previous Inland Act there was some exemption. You know, under this new act there are no exemption. Only few exemption there are for under old act. There, there are exceptions under section 16C, section 16D, section 17, 17A, section 80, section 20, section 20, like that. If that exemption were not over, it will continue under this transition asset. It says they can continue until the end of that exemption period. If that provision was not there under this act, there is no provision to claim that exemption. Even for the BOI companies, before this act, under BOI agreement, there are certain exemptions have been given. So those exemptions, so it is allowed to claim until that exemption period is over. Likewise, you can see when this Inland Act was introduced, uh, few transitional provisions was brought into the act so that something otherwise it is otherwise. For example, if you have started business with because of that exemption, if it is not desired, it is not reasonable. That's why from this transition gazette, it is allowed to use that benefit until that period is over. Thereafter, there are no even BOI agreement. Now you know under BOI agreement, they can't give any exemption. Under previous act, BOI Act supersede the Income Tax Act. So BOI gives a lot of exemption. Now you can't do that. The financial leasing also you can see financial leasing also you can claim capital allowances under section 16. Okay? Financial leasing, what happen actually you are getting the ownership, not operating lease. Under previous act, there's a different way of giving allowances. That's 1/5 of the total rental payable. You have to calculate that way. Then under this act, you can claim capital allowances for asset purchase on financial leasing also. because once a financial issue, that asset ownership comes to you. That's why you can claim uh, financial leasing, capital asset for financial leasing. Now, basically, we will go to our I'll go to your study text. You just with this presentation, you just go through your your study text also. There are something explained actually. This employment income yesterday, last week we discussed employment income. We will look at what are the business income here again. Then this is very important. I think factors to be considered determine the employee not. We actually we discussed this one. We will look at as you know, for employment income, there's only fifth schedule reduction, third schedule, and primary unemployment. These all are related to what we discussed. Then we discussed again, if you look at the business income, you can see page 18. Again, subsection is gain and profit. Always remember, income tax, we are using two words. One is gain, and for gain always come from assets and liabilities. Profit from your businesses. Okay. Then we discuss in our presentation what business include, trade, business, professional occasion. That is excluded an employment because at the dominant principle, and that's why I said, if particular income can come under business income or employment income, it should be treated as a employment income as per dominant principle. Because so for example, you are working somewhere with a service agreement, but you have to go there all 8 hours. You have all the machine, all the equipment are given to you. You are given, you are maybe taking bonus like that. Then what is a service agreement? But if it is service fee, it is a business income. But based on that character, it should be treated as a employment income. Then this is the most important to identify trade business. Okay. What is sold? Purchase of commercial quantities of produce that cannot be used personally. Okay. Length of ownership. If asset is held for a short period of time, it suggests rather than an. If an asset is held for a short period, can you buy and sell like that at short period. If you purchase a land and held for say 20 years time, then it is loan. Length of ownership is loan. You have purchased not to sell, no immediate sale. Then that can be investment asset. For example, if you purchase a land to give your child, okay, you keep it. You have no idea to sell it. So that is a loan period. You are keeping it that land. But on the other scenario, you purchase land and sell. Again, you purchase land and again sell like that. Then you are in the business of selling land. Then it is a business. Repetition. That's why I said repetition of transaction suggests a trade. You buy and sell. Okay? Supplementary work. Trade open processor work turn asset into seizable products. Motivation of activity. Trade requires asset to conclude contracts with the intention of making. You purchase that thing not to hold, but to earn some profit. Then what happens is it is a business income. These are the principles to understand what is the business or investment. I think we discussed this thing that you can see in section 195, that is the interpretation section, even service fee. Service fee also defined. Okay? Service fee means this is a first category of the business income. Service fee means a payment to the extent which based on market values It is reasonably attributable service rendered by a business or person, but exclude interest, rent, or royalty, because those are categories come under the category of investment. It's not a service income. Consideration received with respect to trading stock. Okay, trading stock, we look at the definition given there. Gains from realization of capital. This is other part of the investment business income. So we discuss what is mean by capital asset. If you look at this capital asset, capital again means of the following: land of building, a membership interest in the company, partnership trust, a security to other financial asset, and option or right. Then excluded. Then you can see your vehicle. Your vehicle is actually, it is a capital asset to you, but for income tax purposes, it is not treated as a capital asset. That's why we said your own vehicle, when you are selling, you don't want to pay capital gain tax, because it is not a capital asset. It should be a capital asset to pay capital gain tax. So that is why these definitions are very important. That capital asset means only these four categories, none other than. So when you are reading this thing, as I told, you have to careful these two words, means and includes. When they use the means, they specify something. Okay. Remember, land or building, a membership interest, that is share, a security or other financial asset, an option or right to other interest in asset referred in foregoing paragraph, but exclude the trading stock or depreciable asset. So other categories, business amount required to be in a second procedural on the realization of the depreciable assets and the business. So we discussed depreciable asset meaning in our presentation. You can go through this also. Then we actually, after this business, we come to the other source of income, investment. Investment also defined here. Right? Again, investment means, then it is very clear. Right? It doesn't say investment include, but business include. I think you can't, I think nobody was able to define what is business. Even in, if you look at all other taxes in other countries also, they have not, they are unable to define the word business. Okay. Business has a wider meaning. So investment means the owning of one or more assets, including one or more assets of a similar nature of that are used in integrated fashion, and include the past, present, or prospective investment, but exclude the business or employment. If the particular investment asset or something comes under the business, it should be treated as a business. That's a dominant principle, as I told. Employment, business. Then third category is investment. If something comes under business or investment, it should be treated as a business or investment, not an investment meaning. It is a business, it can be business or employment. So these are actually in our presentation, I discussed these things. Then I told you dividend paid like that. Then say investment income on section 7, and the income, we will go to this section also since we have time. Investment income section 7, then we are discuss up to section 6. Section 5 is the employment income. Section 6 is the investment income. Section 7 talks about the investment income. A person income from investment shall be person gain and profit from investment specified inclusion in section 7(2). Dividend, interest, discount, charges, annuities, nature. These are, as I told you, these are the type of investment you can have. Dividend can be a investment income or interest, and things like that. The term dividend, interest, natural resolution, and royalty are defined in the section 195. Then dividend also has been defined in this act. What do you mean by dividend? The interest, when you say interest include, you just go to this, your textbook, you can understand what are these things. Then rent again also, rent means, that is very clear. When you use the word, it is very clear to understand. Rent means a payment including payment of premium or like amount for the use of right to use property of any kind. For using the property only, you are getting some rent income. Include a past percent of include the payment of rendering of the undertaking of render assistance ancillary to use of a right reported above, excluded natural resources payment or royalty. Then the royalty has been separately defined. That's why royalty has been excluded from the meaning of the rent. The royalty has been defined. Royalty means payment including the payment of premium argument, direct consideration for the use of right to use of copyright literacy like that. These are the royalty. You just go through these things, then you can somehow understand what we discussed today. Gains from realization of investment asset. As I told you, there are 4 kinds of assets. Only 3 kinds of assets are relevant to business income. So, realization of business asset, depreciable asset, and trading stock. Those 3 categories are related to business income. So, gains from realization of investment asset, only the 4th category of the asset is relevant to this investment income. Gains from the realization of from the investment asset, as get under chapter 4. Actually, there's a separate chapter to explain how to calculate gain. Now we are talking about profit and gain. Then gains comes in your asset and liability. So asset and liability section 36 to section 50. There's a loan areas to understand how to calculate the gain. We will discuss later those things. So investment asset means a capital asset. Investment asset also capital asset means held, but it is held part of investment. For example, you have purchased land to give your child. That is, you have not purchased that land to do some sort of business. Land is a capital asset, means a capital asset. Held as a part of investment. You have invested not to do some any business. It is your investment. So that is investment asset. So capital asset can become a business asset or investment asset. Okay. Exclude the principal place of president of individual provided. I discussed it then in my slides, my presentation also. If your principal place, you have the ownership for last 3 years, but by the time of selling, you should be physically lived there for more than 2 years. When you are selling that property, that gain is exempt from income tax. So we discuss amount of derived as condition of accepted restriction on the capacity to conducting an investment. Gift again, that gift we show even when we are talking about employment income, business income, we show the word gift. Gift received by person in respect to investment. Even for investment, when there's an investment, if you get some sort of gift, that is also should be included as a part of investment. That is whatever comes under your investment, it should be taken to your income. Winning from lotteries, betting and gaming. Other amount reported. Then exclude XM amount and final withholding. Again, that XM amount and final withholding payment have been taken out from your investment income. Amount that are included in calculated persons from income from employment, and as I told you, as per dominant principle, but if any investment income can be categorized as employment or business, this should be excluded. That should be treated as employment or business, not as investment. We will look at this example given in your textbook. Mr. Silla, who is a resident in Sri Lanka, acquires an office building and the land it is situated during first year for rupees 30 million. Mr. Silva's activities passively renting out the property do not fall within the definition of business. If it is passively renting out of a building, do not fall within the business. There is no trade. Mr. Silla intends to hold the property which will produce an income of itself through the rent. Further, assuming that Mr. Silla only office building, there is no repetition. His activities do, however, clearly fall within the definition of investment. Okay. So in this category, this is an investment. At the end of the year one, Mr. Silla must calculate his income from investment under Section 7. That is then that income from office building, renting building, that should be treated. The situation would be different if Mr. Silla owned and rented out 5 office buildings. As I told you, that there are not only one car. 5 office building and manage the property by manager. He has taken manager also look after his properties and staff. Here the repetition and the activity manage engagement of Mr. Silla with the properties would be sufficient to constitute a business of property rental. So at the end of first year, Mr. Silla must calculate his income from business. You can see how investment income and business income changes, no? For the first category, he has only one office. He passive rented out it. He doesn't do anything. He end of the month, every month he is getting rent income. So in that category, in that situation, it is a investment income. But if he hold more than say 2, 3 buildings, he rented out. He has a staff to look after this property. Then what happens is that rent income is a business income. That's the effective connected with business. That's the, in the under that category. Otherwise, this rent income is defined as a investment income. But if it is effective connected to business, it should be treated as a business income. In your textbook, there's a given, for example, for capital gain tax. We will discuss later because this is a separate chapter to discuss capital gain. Mr. Anura purchased a land on 21st October 2024 rupees 1 million. That means 2015 he has purchased for 1 million. Market value of the land as a 30th September 2030. That 2017 September value is most important because when the new actually this gains was made liable to income tax under this new act. Under old act, capital gain was exempt. So therefore, capital gain up to 30th September 2017 is not liable to income tax. That is why we take the market value of the property as at 30th September 2017. That is the reason, because actually this day should be 31st March 2018, because this act is applied from that year 2018-19, but initially they want to implement from this year, this date. But when they are actually when they are releasing the gazette, they couldn't change this thing. That's why gazette says 30th September. That's why even act this says market value as at 30th September 2017 should be taken. That's why we are taking that value. Otherwise, this value should be as at 31st March 2018. Because from that date only this income tax act applies. What happened is that day value is 3.5 million. He improved the land by investing rupees. He has invested 500,000 to improve the land. On 16th October, again after that September, after 2020 September, there are some expenses. He sold the land on the 1st of October 2018 for rupees 5 million. He incurred advertising expenses rupees 10,000 and lawyer's fee to 200,000. Market value of the land asset the 5 million. Okay. So you yes, for the 5 million, but actually market value, we have to look at the market value, it is also 5 million, then no problem. Then you have consideration, you can take it to market value 5 million. Then what are the costs you can deduct? Market value as at 30th September, that cost is 3.5 million. The improvement cost after that date, okay, after that date, there are improvement costs of 500,000. Then specifically the incidental expenses. Incidental expenses like advertising, lawyers fee like that, those are considered as incidental expenses incurred with the sale of your asset. That type of expenses also, because related to your income, you are getting income after deducting this cost. That's why that cost also you can deduct when calculating your capital gain. Then incident altogether 4.2 million. Then gain from the realization of investment asset consideration, you receive deduct cost. Gain is 709,000. Then your capital gain tax is 10%. Therefore, that this transaction, you have to pay capital gain tax at 10%. Now, actually, now you know under new act, now it is not yet implemented. This rate has been increased to going to be increased to 15%. But that act is passed in the parliament when the act is come to the implementation, it will be pretty much up to now, you can pay 10% because there is no act to charge 15%. That's why he said until that act is passed in the parliament, they are continuing at the same rate. But company, this rate is 30%. Initially, even company, this is a reduced rate, but later, company, they increase the rate from 10% to 30%. Now, company tax rate is normal, their corporate rate. For individuals, 10%. This we discuss when we are calculating these are the special deduction exception for your exemption. A dividend paid by resident company to a member to the extent that dividend payment is attributed or derived from under dividend received by that resident company or another resident company that was subject to withholding tax. As we told, this type of dividend is excluded from your investment. That is actually that dividend is the final withholding payment to you because that other party has deducted tax and pay you. The interest derived by a charitable institution provided derived by a charitable institution provided care to children, the elderly, or the disabled in a home maintained by such charitable. That type of interest income of charitable organization established for these purposes. Look after elders, look after disabled person. They should have home also. That type of charitable, the interest income, they are getting certain donation. When they deposit that money, they are getting interest income. That interest income has been excluded. An amount equal to the interest or discount paid to the allowed as the case may be to only non-resident person or to any licensed commercial bank in Sri Lanka by the issue of any sovereign bond accommodated in foreign currency issued, after 21st October 2008 by or on behalf of the government of Sri Lanka. That interest also excluded from your investment income. Any amount derived by senior citizen of any, and then it was that also that you also this is also now it is withdrawn. Now this is not applicable now. That's why I told you you can look at your constitutional act. There's the main act. There are the amendment act. Some amendment act. Some are taken out. The relief. These are in the case of who is a senior citizen. This is also now not applicable. In the case of individual with the rental income from a resident investment asset, if you have rental income, then if it is investment income, you can deduct 20% of the rent allowance. So, for example, if you have a 4 million rent income, your 25% allowance is there. Then 1 million you carry, the balance 3 million is liable to income tax. 25% relief is there for rent income. Then actually, there is, I told you, any other income which cannot be categorized under the above main sources. Main sources is employment, business and investment could be come under this. This is more, very, I can't say these are the other income, but if somebody argue this income does not come to either employment, business or investment, that's why they brought, because people are arguing, looking at those, for example, business, they say includes, then one can argue the particular income is, I have not done this as a business. So that to capture that type of income, they have introduced this source. Then what happens is whatever income you are taking, other than if there's no exemption, all have been taken. Now, mostly now, under this category, like that solar power. When you fix solar panels, you are getting income, electricity board. Actually, that solar panel, we can say, you have not done it as a business. To reduce your electricity cost, you have done that. It is actually not an investment. No? So you have not done investment to earn income. So that a particular purpose you have replace that asset. Then whatever you are getting from the electricity board, then IRD said that should be treated as if you do not treat, for example, if you are doing a business, if you have business, you can take some properties and do it as a business also, no big companies. So for them, there's a business income. If it is not a business income, individual like us, so that type of income can be come under this other income. So most probably, if you look at company, we don't find any other income because all are come under the business income. Company is concerned. So the asset profit and income, this what in our section, in my presentation, I specifically discuss. You better to go through your textbook also. Textbook also explain further what I explain you today. This we discuss general rules. I told you there are three categories of deducting expenses. First one is general rule. We discuss in our presentation all these things. Then domestic expenses also, I told you this is defined. Right? Domestic expenses. We will look at what do you mean by domestic expenses? Where an individual incurs expenses in respect of himself, the expenditure shall be domestic expenditure to the extent that it is incurred in maintaining the individual, including the provided shelter, as well as meals, your foods, refreshment, entertainment, or other issues. That means these, you can see these are the personal type of expenses. Domestic expenses means personal type of expenses. In the individual commuting from home, that means your personal type traveling expenses. In the individual commuting from home, if you are going somewhere from your home, that travel expense actually you can't claim. It is treated as a domestic expenses. In acquiring clothing, including shoes for the individuals other than clothing that is not suitable for wearing outside of work. In educated individual, you can see all these type of personal expenses are treated as domestic expenses. Domestic expenses are not allowed to deduct from your tax computations. This act is very important because even simple things, this act has been defined so that for you easy reference, you know then what should be deducted, what should not be deducted. We discussed this main role. Main role is the most important. Main role in calculating person income for business, investment for reassessment, expenses to the extent that are incurred during the year by the person in the production of income to earn your income from the business or investment. That I told the section told that type of expenses you can deduct either from business or investment. Section 11. Section 11 expenses can be deducted from business and investment. Not be allowed under for expenses in the capital nature. That's why capital nature expenses you can't deduct, but thereafter under section 12 to section 19 introduce some expenses to claim that type of capital nature expenses. So we discussed these things. Interest expenses. Interest expenses can be, you can't say it is a revenue. That interest cost give a benefit for less than 12 months. You can't say like that. Sometimes it give benefit more than 12. That interest expenses can be a capital nature. That's why specifically it is given under this section. You can claim capital interest expenses, but there's a restriction to claim interest expenses under section 18. Then we discussed this claiming of capital under section 13, trading stock you can deduct. This repairs and improvement section 14. We discussed this one. You go through this thing. Then you can claim, you can understand how these things are. We will take a simple example for your reference. Year of 2018, an asset purchase for rupees 2 million in the same year, repairs of the asset of rupees 500,000. Year of assets 1920, repairs of the asset purchased in year of assets 400,000. The new asset purchase say 3 million. Year of assets 2021, no purchase and repairs. And repairs 2 million. Then year one. There is no written down value at the end of the previous year, hence deductions are not entitled to account of a repair, but capital allowance are claimable for the purchase of asset for rupees 2 million. Repairs cost get added to the value of asset after deducting capital allowances and claim from the 2009 onwards. Year 2, 19, that this example you can read this thing and you can understand. So you can see written down value 2018-19. There was no written down value because that is the first year of your income calculation under this new act. 2018-19 the first year under this new act. So repair cost you have 500,000. Then capital allowance you can claim 200,000 divided by capital allowances per years you can claim. Machine applicable rate is 20%, that means 5 years. 200,000 you can claim first year as a capital asset. What happened is at the end of the year, you are then 2 million, you deduct 4 million, that's 1.6 million you can claim next 4 years time. Then that 500,000 you add to the your written down value. So your depreciable basis at the end of the year 2.1 million. Because initially, because this 500,000 you can't claim because you didn't have any depreciable basis from the beginning. That's why you added this 2.1 million. Well, you look at the what happened second year. Second year start 2.1 million. Then there's an addition of 3 million. Then repair expenses 400,000. And repair expenses, the maximum claim 2.1 million into 20%. No? That means 420 you can claim, but you have incurred 400,000. Entire 400,000 repair cost you can claim. Then how to calculate that capital asset? 2.1 million divided by 4. That is 525,000. Then during the year you have addition, other 3 million, that's also within 5 you can claim. 3 million divided by 600,000, 5 is 600,000. Altogether, particular capital allowance applicable for that year of assessment is 1,125,000. Now, what is the written down value basis? Then 2.1 million beginning we have. Then deduct 525 as a capital for the year. Then we capital allowance after deducting 525,000, we have 1.5 million. Then we purchase a new asset for 3 million. We deduct 600,000. Their balance is 2.4 million. Then the written down the basis for next year is 3.9 million. When you come to the third year, 2.9 million, then 2 million, first we have to deduct the first asset 150 million into 20%, 315,000. Then then what happened is here, repair cost, you have incurred repair cost of 2 million. But your repair cost, there's a limit, 1.5 million into 20%, 315,000. Only 315,000 only you can claim because this old asset, not the new asset, that is 1.5 million, new asset 2.4 million. That's how we came to 3.9 million. Now maximum amount allowable is 315,000 for that year. So this 1.600,000 is not allowed. So then how to calculate this capital? 1.5 million divided by 3, 500, then 2.4 million second asset. That we have 4 more years. That the first asset we have 3 years. Second asset we have 4 years. The 600 are total 1,150,000. So what happened is that the end of the year that you cannot claim that additional repair cost. You can add to your depreciable basis. So depreciable basis, and you can claim in the corresponding year of assessment. So as you see, there's a restriction to claim repair expenses. Addition is a new addition. The addition, but separately, it is claimed within the particular year of asset is with the machine. It is a 5-year period. You can see that that is how you calculate the capital allowances. The research and development expenses we discussed, then agriculture startup. For example, you purchase a land and cultivate, process cinnamon. Cinnamon, you getting revenue, say after 4 years. After 4 years only, you can get the income. So initially, that cost, because you don't have, basically it is a capital nature expenses. So agricultural expenses. So that's why that agricultural startup expenses under this section, and research and development also. If you do a research, the benefit will come after 2, 3 years back, maybe sometimes 5, 6 years back. So that's why that is so the benefit give after 12-month period. Okay. Then the capital nature, but under this section specifically allowed. Then again, this section agricultural staff expenses has also defined. Okay. Opening of land for cultivation or animal husbandry, cultivation land referred in paragraph 8 with the plants, the purchase of livestock or poultry to be likewise. So we discussed this capital allowances in section 18, depreciable asset. With my presentation, you can read that. Actually, my presentation, I show how to calculate this. There are basically at the beginning, actually, there are 5 categories. Now there are 6 more categories I included in my presentation. This how we can claim capital as computers, data handling equipment, together with peripheral devices. It should be within 5 years. That means 20%. The second category, buses, minibuses, goods vehicle, those type of asset within 5 years. That means 20%. Third category, railroad cars, document equipment, vessel. In here, you cover office equipment, furniture, everything come under third category. Those are machinery, equipment, and machinery also come under third category. That is also period is 5 years. This is a longer period, building and structures, longer period, 20 years. That means 5% per year. 5% of the cost you can claim. That is within 20 years, you can claim total cost. Or intangible asset, the actual, if you know the actual useful life, it should be that period. Otherwise, it is be limited 5% per year. That means within 20 years, that entire cost of intangible asset you can claim. We discussed this thing, calculated the capital also. You can read this thing without my presentation. This commercial vehicle, why we discuss what are the commercial vehicle, what type of asset vehicle we can claim capital losses. We discuss about a balancing allowances and this thing. Assessable charge, we discuss assessable charge. If you have profit, balancing allowance, if you have loss, basically, when you are selling a depreciable asset. We discuss this thing. So, this example is given how to calculate capital allowances. If it is 5 million, you can claim every year 1 million each. So 5 million you can claim within 5-year period. This is a good example for balancing to understand the balancing allowance. Assets purchased in 2018-19 for rupees 5 million is sold in year of assessment for 2.5 million. So here A is rupees 2 million, B is rupees 3 million, because you know this 5 million you have claimed to 1 million each within 2 years. Now balance is 3 million. Now balancing allowance is 3 million minus 2.5 million, B minus A, because your sale proceed less than your written down value. You can see on the category 1, depreciable basis 2021 is 3 million, but you have sold it for 2.5 million, then you have loss. That loss you can claim. This is how balancing allowances comes. This example is in your textbook. You can go through this textbook and understand this. Taxable charge also we discussed the other way around. But assume the same asset is sold in 24 rupees per million. That is, then you have to take A minus B because your selling price is more than your written down value. You sell it per million, the asset written down value is 3 million. 3 million. Then what happens is you are getting 1 million more. That 1 million you have to pay tax. That 1 million should be treated as your business income. That amount of financial cost we discussed, this deductible amount of finance cost. I told you then in up to 2022, in the case of manufacturing entity, this A A is the total of the issues. That means you can create, you can borrow 3 times of your asset shares and reserve. Now it is abolished. Now all the companies, it is 4. Any company can borrow 4 times of your shares and reserve. That you can borrow, but there's a limit of financial cost. You can there's a limit to claim capital finance cost, but that balance you can claim in subsequent years. There's a restriction to claim financial cost. Otherwise, it is not disallowed. The whatever excess amount you can claim within 6-year period. That's why. Here also, A Limited is a company carrying on a manufacturing business. That's actually before 2022. That is the time is 3. Now this is 4. Even for manufacturing company, they can go up to 4 times of their share capital and reserve. Share capital is 4 million, reserve 3 million, long-term loans 40 million. Then A is 4 million plus 3 7 million. Finance cost, attributable finance cost, you can go 3 million to 40, 0.5. Set for A means 4 plus 3, 7 million, B is 3. So this is way how you claim the financial cost. The interest not allowable for the year of assessment 2009 rupees 3 million under 1.4 million you can pay, which is allowed to be deducted for the year of assessment by the admin as financial cost that year, and apply the above deduction rule, which is will continue to be applied for 6 subsequent years. Whatever cannot be claimed, you have borrowed more than in that limit, that additional cost you can claim within 6-year period. That's why. Yeah, again, take an example. A runs a restaurant in your textbook. There's an example. A runs a restaurant in Colombo. He also holds a substantial portfolio of unlisted shares in various. If the listed shares, sale of listed shares, code of public company shares is exempt from income tax. The dividend received is anyway final withholding payment. That sale of quota public companies is not liable, but this is unlisted shares. Okay. So year 1, he has a loss from business. 1 million. Then he has a sale of shares 300,000. Year 2, he has 500,000. Year 3, 1 million loss. Capital gain 500,000. Year 4, he has a loss, no capital gain. Year 5, 200. This is how business loss can be carried forward under section. Business loss you can carry, but investment loss from the realization norm cannot be. For example, if you look at the first year, he has a loss, but this 300,000 you cannot carry forward. If there's investment income, he should be able to claim this 300,000. Since he doesn't have a investment profit, he can't claim because the investment loss can be claimed only from investment income because he has to forget this loss. But this business loss, 1 million, he can carry forward for the next 6-year period. Okay, that's why it says the the profit per pirate is not taxable as there is a carry. For the second year, you have 500,000, but first year you have a 1 million loss. Then you can set off that 500,000 from that loss. Then your taxable income becomes zero. Second year also, you don't want to pay tax. Then you have a carried forward loss of 500,000 from 1 million. You set off 500,000 against your profit. Then balance 500,000 carried forward. For the year 3, you have a brought forward loss of 500,000. Then year 4, the loss for the year 100,000 carried forward rupees 1 million, rupees 1.5 million. Year 5, what happened is rupees 2 million, 1.5 deducted 900,000, then 900,000 plus this 200,000 capital gain is liable to income tax. Because 2 million, and you can do the 1.1 million carry forward loss. Business also you can do that. Then you have business profit of 900,000. Capital gain, you have to pay capital gain. If it is a person, that is 10%. If it is a company, this is Mr. A. Mr. A is a person. Person liable rate is 10%. So this capital gain, he has to pay 200,000. 10%. This 900,000, there's a 1.8 million is tax free. You have to take so your income from all four sources. You have to then calculate your income. Now 1.8 million is tax free. Next 1 million is 6%. Progressive rate. Then next 500,000 is 18%. Next 500,000 is 24%. Next 500,000 is 30. Balance is 30%. Like that way, you have to calculate this profit for an individual. For a company, there is not strike like that. Whatever your taxable income is taxed at the standard rate given. So up to this page 44 of your textbook, now you can read that we have covered that basically all four sources of income: employment income, business income, investment income, and other source of income. You go to my, I will send to this. You will get this presentation also. With that presentation, you go through this thing. In similarly, if you have time, you better to go to your consolidated act also. Then you are reading three type of things. Then you will understand. Actually, we can guide you how to understand this act, because we can't read within a shorter period. Actually, if you look at instead of taxation, there's a 2-year course, a longer period. But within short period, we can guide you how to understand how to. Anyway, we will do some company tax and individual tax also. Then you can, after the end of this course, at least you should be able to do your own tax. You don't want to ask somebody else to do your tax. Then you can do it yourself. For a company also, you will understand how this tax computation is done. Why these expenses are allowed? Why these expenses are disallowed? Once you did the company tax computation, then you should be able to question why this is allowed, why this is not allowed. After you understand this thing, we will do some exercises. Then we will understand better how to calculate business income, investment income, and employment income. Employment income, as I told you, employee doesn't have to do anything. Company is doing everything. If you have purely only employment income, you don't want to even file the tax return. It says if you have no other sources of income, if you have only employment income, what happens is monthly your tax is deducted by the employer and remitted to the Inland Department. End of the year, you are getting T10 certificate. T10 certificate, it is your gross remuneration, whatever tax paid to the government. All the information are there. If you don't have any other income, you don't want even to file a tax return. But if we have employment income, one more income for investment income. For example, in addition to employment, you have interest income. Then again, there's a inland environment. They didn't consider if it's a minor interest income. But for example, you have say 1,000, 2,000 rupees interest income. They still said you don't want to file a tax return. But now what happened is, now in the new act, I think it is not yet published. They have given amount. If you have the 5,000, I don't know whether it is changed after committee change. Now, as per the draft, if you have employment income plus if your interest income is less than 5,000 rupees, still you don't want to file a tax return. If you have employment income more than interest income 5,000 rupees, then you are liable to file a tax return. Okay. Then employment income you can't deduct any expenses. That's why you don't want to file a return if you have employment income. For the business income and investment income, uh, you can deduct expenses. Then, as you said, the person's profit and gain. They use two words. Profit. Profit come from your business and investment from your activities. Gains, there is no activity. Gains come from your asset. Your asset is increased. You from the from the from from the market condition, your asset value can be increased without doing anything. So that's why you are not doing something, but that asset increase that is treated as a gain. That profit and gain. Gain always comes from your assets. Profit from your day-to-day activities. You have to do something. You have to involve you that to earn profit and gain. Okay. So now I have actually textbook also we have covered up to 44 page 44. You can read all those things. And I have done separate presentation also to cover these areas. Then we will do some exercises based on this. Then we will better understand. I want to finish this theoretical part as soon as possible so that we can start the exercises. Then in the taxation, actually, you have to do exercises to understand. Otherwise, you can't uh, understand how to calculate taxes. Actually, this textbook was done at the beginning of the coming this new Land Act. Actually, now certain areas have been changed. That's why I told you to look with this one. You have to look at the Consolidated Act. Consolidated Act, you can understand the areas that have been changed. So as you know, every year actually tax is getting changed. Some area is getting changed. So when there's a problem, then IRD give some solution to resolve those questions. Then it comes by way of amendment. Even if you look at even year of assessment has been defined. Normal year of assessment is from April to March. But for certain categories, for a trust or some association, they can go to IRD and, for example, bank their financial year is from January to December. They have taken special approval from the Commissioner General to take their year of assessment as from January to December. So for that, you have to take the approval from the Commissioner General. Otherwise, normal year of assessment is 1st of April to 31st March next year. So we discussed these things: person, entity, partnership, trust, everything. Then I told you person means an individual entity. Ne? Company come to the person under the category of entity. Under person, individual is there, but company is not there. But when you look at the entity means company or partnership. That way, company has come to the meaning of person. Or any person, when you say any person, individual, company, all are there. So section 195, if you have time, you can go through first section 195 of the I have shared that this Consort Act. You can understand all these things. Then it is interesting. Once you understand this term, then you can better understand how to calculate, how to get these things. Look at the charitable insurance. Charitable insurance means the uh, trustee or trustee of a trust of corporation or incorporated body or person established for a charitable purpose only engaged solely in carrying out a charitable purpose. Then charitable purpose also defined. You can see charitable purpose, the relief of poverty and advance of education, activities of protection of the environment, the advance of religion or maintenance of religious activities, any other purpose beneficial to the community. So under those five categories are treated as charitable purposes. Those are enrolling on those charitable purpose are the charitable institutions. That way you have to read that. Then company also defined. This is basically how calculate when we are doing understand calculation. We will look at this format, how to calculate assessable income, taxable income, then how to calculate tax, like that. To go through from, as I told you, from the beginning to the page 44, and you then output that we have covered. Now we have to, then we will do some few example, few sums so that you can understand how we can calculate the taxes. So if you don't have any problem, we can stop from this point. And because this is the theoretical area, I don't want to take more time. Actually, when you are doing exercises only, you will understand all these things. And we will do exercise once you understand. You better to go through this textbook and my presentations, and also you can, if you have time, better to go to ACT also. Then you are familiar with that rather than presentation or like this. You know where is the law, how law is defined these things. If you are familiar with that, it is very important. Then you have to read maybe several times. You have to go through the same thing, then you will get some idea of this thing. So actually now we have discussed, income tax should be paid on income from these four sources: employment income, business income, investment income, other income. So we have discussed all those sources of income. Now next step, we will take some examples and few company excess and individual excess, and we'll do some calculation coming years to understand. After we finish this theoretical, then we have to discuss assessment, appeal on assessment, and some other few areas. And we will discuss some more, little more about gain on capital gain, how to calculate capital, what are the exemption area like that. And thereafter we can start exercises. Okay. So I will stop from this point and we will start next year. Okay. Thank you.